Hey guys, Sam here with Sam in Real Estate and Finance on another video. In this video, I'm going to show you how to use an ARM mortgage calculator. In a previous video, I showed you how to calculate an adjustable rate mortgage or how to calculate the rate on an adjustable rate mortgage. So in this video, we're going to talk about how to use a mortgage calculator to figure out what your payments will be like on an adjustable rate mortgage or ARM. But before I get started, please make sure you like and subscribe to this video. It just really helps me out with the YouTube algorithm. I love creating videos like this to educate people on financing, mortgages, and real estate. All right, so let's begin. So in the previous video, I talked about adjustable rate mortgages and how it's calculated and the different types of ARMs. So here in this little graph, you can see that these are the different types of ARMs. And here you have a 3-1 ARM, which 3 meaning that it's fixed for 3 years and 1 meaning that it adjusts annually. So a 5-year ARM, so it's fixed for 5 years and it adjusts annually after that 60 months. Then you have the 7-year and you have a 10-year. Now down here you have a 3-6, which means that it's fixed for 3 years and then after the 3-year period, it adjusts every 6 months. Same with the remaining ones here. You have a 5-year, which 5-6 ARM, which means that it's fixed for 5 years, then it adjusts every 6 months, and so on and so forth. So these below here, the 10-6, the 7-6, the 5-6, and the 3-6, you typically see a lower rate, but obviously these are more risky because if your rates adjust every 6 months, it can adjust up or it can adjust down. So there's a little bit of fluctuations. It could be volatile during that period, and your monthly payment can fluctuate with this type of ARM. And it can be unpredictable because we will not know at what point of the market cycle we'll be in when these rates adjust. Now, with a 3, 5, 7, and a 10-year ARM, or 10-1, 7-1, 5-1, and a 3-1, obviously there is going to be some fluctuations, but you still have at least a year before that rate adjusts. So yeah, it fluctuates, but you still have plenty of time to kind of adjust to the rate either going up or the rate going down. I would say if you're going to get into an ARM and you're looking to refinance, it just all depends on what your situation is. You know, if you plan on being in the house, but you want a lower rate, you can look at a 7-1 or a 10-1 where you can refinance before the loan adjusts. And that way it gives you some time. But again, this is speculating because we don't know what rates will look like in 7 years or 10 years. So you do carry some risk taking out one of these mortgage loan products. So you have to have a set plan and know exactly what you're doing. All right, so I'm going to have a link to this calculator in the description so you guys can play around with it. But let's just say you have a mortgage of $250,000. The term is 30 years. Your initial interest rate is 4.85, and here is your monthly payment. Now, this is without taxes, insurance, and HOA fees or anything or escrow. So this is just your bare monthly payment. So now we factor in adjustments. So let's say you have a 5-1 ARM, right? So this is 60 months. So this is 5 years, and it adjusts. So this will actually be a 5-6. Right? So it's going to adjust every six months. So after the 5 years, it's going to adjust every 6 months. And let's just say the adjustment is 0.25, right? So this is 0.25 going up. So this is base. And then your cap, meaning the rate cannot go any more than this, or you will not have a rate higher than this amount. This would be your cap. Here you can see that your payment would be $1,601. So you go from a fixed of $1,319, and after the 5-year period, it goes up about 0.25, and it adjusts 0.25%, and you see an increase of almost $300. So that's a huge jump, right? So my suggestion would be, if you're going to get into an ARM, you want to refi before it adjusts. All right. Okay. So now in this example, we're going to say the months before it adjusts is 5 years. We have a 1-year adjustment. So every 1 year it adjusts, and it's going to adjust instead of the one we originally had, we're going to say it adjusts minus 1.5%. So with a minus 1.5%, what are your payments going to look like? So it's going to be an adjustment of 1.5% from your initial 4.85%. So you're going to minus the 1.5 from the 4.85, and then we're going to go to view report, and it should give us what that rate will be. So it'll be 3.35% after 5 years, and your payment is going to come down almost a little over $200, and you'll be, instead of paying $1319.23, you'll be paying $1128.48. Mind you, this is without taxes, without including taxes, insurance, and HOA fees and escrow. All right. Now, after a year after that, your rate cannot go lower than 2%. So it's not going to go lower than 2%. But if it adjusts and it continues to drop to 2%, your payment even goes lower, another a little over $200 to $976. So not likely that that'll happen, but it's a possibility depending on what the market is doing at that time. So this is a great calculator. You can really play around with this, look at what current rates are, and just plug these numbers in and just kind of see if, this is something that you might want to consider. Again, if you're going to do any of these ARMs because you're thinking about getting a low rate, just keep in mind that these rates will fluctuate, and depending on the terms that you have, they can adjust annually or every 6 months, depending on the ARM type that you get. All right. And the goal really should be to probably get in at a low rate and you want to look to refi out of these types of loans, because you don't want to get caught with an adjustment period where the rate adjusts upward and your payments are way over where you can afford to make payments on the property. So that's it for this video. If you guys have any questions, I'll have a link to this calculator in the description. And yeah, I'll see you guys on the next one.